So this is part 2, and we just managed to replicate the payoff on the first option associated with the lower exercise, and logically following, let's take these two short call positions and see, can we map those values out. We can perhaps eliminate the blue because it's not in the original. There is no equivalent position here, so we just deleted that. If you like that value, get to delete that value away, we just highlight and delete and it's gone. So what we would like to do is, well, we probably should try to create 3 option positions, and we could copy this and paste below just to remind us what that function is doing. And we might, in fact, we could say equal to the previous. And bring that across, and then pull this down. And then consider we have the 3 separate exercise prices. So it's no harm to stress this a little bit, I suppose, that if this was the lower exercise price, if the lower exercise price was 80 and the highest exercise price is 120, the middle exercise price, so if we have C1, C2, C3, the middle exercise price must be exactly halfway between 80 and 120, and that would be 100. Okay, so we have, if you like, the premium associated with the 3 options, and the butterfly, the cost of the butterfly would be, you're buying the first option, you're buying the last option, and then the middle option you are, so we'll say you're shorting 2 times minus 2, because you're shorting minus 2 times the middle option, and that's generating income, and that mitigates the cost of setting up the strategy, the fact that you're selling 2 call options at 10. So the overall cost of setting up the strategy here, given these parameter inputs, is 693. Also notice that if we increase this to 0.3, these values rise in turn, and we have a fall here in terms of the option price. And we can bring some interpretation here, because the spreadsheet is going to be dynamic. That will be useful later on in offering some interpretation of what's actually happening. So we want to create, so this, if you like, is C1, and we would like to create C3, and C3 or C2. What's the C2 intrinsic? Now, should we make it initially short? Well, first of all, just set the strategy out. The C2 intrinsic, if it was a long position, then it would be the payoff on the option, the intrinsic value of the option, if it was long, would be S minus the X, the exercise associated with C2, and we'll F4 that, dollarize the cell reference, 0, close brackets, and we'll drag that down, so it generates for the entire range. And then, because this is long, we want to short 2 short positions, and we also need a premium. Okay, so perhaps before I take it further, keep the position long. So let's say C2, and let's say incorporate into premium as with what we had done before in this column. So we incorporate the premium, and that's just simply the validity option, and we subtract away the premium associated, generated by Black-Scholes, but associated with C2 and the middle exercise price. And we have the F for that as well. And we pull it down. And then two short positions for C2 with premium would be just -2 multiplied by what we have here. And we'll bring that down. And if we want to enter that into our spreadsheet, into our graph, select data, and maybe we should edit the first one. So edit, and I'm going to call that C1 premium. So C1 premium, which means C1 with premium. I want to add, so now it's C2 short C2 with premium. Again, the x-axis is never changing, it's always referring back to the range of asset prices that we've allowed for. The y-axis is going to change. And click OK, and click OK, and we'll eyeball the graph. And yes, the blue corresponds with this middle one here, and the red corresponds with the previous. Okay, so we can add later some granularity in terms of the graph and so on. Okay. Now lastly, we also have to incorporate in, so we might need to make some space, premium, bring this a little bit in just so that our space is better managed, and the rest can't really. Okay, so now we want to do C3 intrinsic. So intrinsic, and that is just equal to maximum S minus the exercise associated with the higher exercise with C3, F4, comma, 0, and we can pull that down. And we now need to deduct the premium, so we'll say C3, and incorporating the premium is equal to what we've just worked out minus the premium generated using Black-Scholes. And we must F4 that to lock the cell reference, and again pull that down, and again let's incorporate that. So select data, add C3 premium. What's on the x-axis is the range of envisaged asset prices, stock prices, whatever the underlying happens to be, and this is our range of values for the payoff on the option associated with the higher exercise. And click OK, and again we can see, relatively speaking, we have this type of dynamic. Higher premium associated with the lower exercise on the call option. Okay. Last but very important, is the combination or the portfolio. So I'll call it combination. And what's the combination? We said the butterfly combination. The butterfly combination is made up of the long call with the lower exercise plus the long call with the higher exercise, and then minus, but we've already incorporated in the minus here, so we can say positive the two short positions, which we have here. And we can pull that down. And then we can incorporate that into our graph. Select, add, and I'll just say combination. So it's basically the butterfly strategy, same range of stock prices on the horizontal axis, and for the y-axis, the butterfly itself. Click OK, click OK. And now we have the purple, which corresponds to what we have here. Now, because we set it up in Excel, we can refine a little bit better the graph. So starting here, maybe format the axis, and we'll fix the maximum value to 200, and likewise 100 and 200. Okay, so maybe format axis, the minimum value, we'll fix it 170, and the maximum value doesn't have to be, could be 120, 130. Close. And okay, we can now also perhaps in the design, so select a graph that has more granular detail. So we can see plainly 50, 100, 150, 100, 80, and 120. So two boxes further out from 100, 120, and lower. Okay, and this we could write as the combination, or probably better, payoffs. And here, asset values. And we could put this underneath, format legend, bottom, and look. Now, if we change the volatility, perhaps we get greater. Now we change 0.4, maybe the time period we change to 2 years. Okay, so we can see how the option strategy is dynamic, and we can change this to 3, maybe 4 years. Everything updates, and 0.3 might become 0.4. Okay, so as we change these values around, you can see the dynamic change. So as I reverse those, we can look at a kind of compression in the spreads. So these values here, let's go back one more, correspond with the general shape of the butterfly here. Again, importantly, what does the butterfly provide? Well, we look at the combination overall. If the stock price remains within a particular range, we make a profit. If the stock price goes outside the range, from slightly over 80 and slightly underneath 120, then the strategy starts to lose money. To set up the butterfly strategy,